Hi everyone, hope you're all doing well. Today I'm going to do a proper video again, and today I'm going to do the UK stocks I'm buying September 2024 edition. So this is where I go through all the UK stocks that I bought and sold from the 1st of August to the 1st of September. And I've done this video series on the YouTube for many years now, and it just keeps up that transparency so you guys know what I'm actually buying and what I'm actually selling. I also did my US version a couple of days ago, so go check that out if you want to see the US stocks. But yeah, I've done this for a few years. Like I said, it just keeps with that transparency. Many other YouTubers on the YouTube scene, they talk a good game, but actually when it comes to it, if something doesn't work out, they'll quietly sell something out in the background and hope you don't notice. Whereas for me, I'll make sure I tell you if I sold it at a profit or a loss, and I'll also tell you what I'm buying in real time, so I don't turn around to you guys in a couple of years time and go, oh, I just sold this stock for this amount of profit, and never mentioned it previously but only mentioned it when it's gone up. If it works out, you guys will know. If it doesn't work out, you guys will know, because I'm actually telling you what I'm buying right now. There's no hiding. Sometimes it costs you being transparent, but I'd rather be honest with you guys and you can judge me on that, and that's what I do on this YouTube channel. So without wasting any more time, let's get stuck onto these stocks I'm buying. I think there was 5 stocks that I bought, and I think there was 1 stock that I sold. So I hope you enjoyed the video, guys. Hit that like button. Try get me to 16,000 subscribers if you can by the end of the month, and I'll do a live Q&A session as well on the YouTube channel to celebrate the 16,000 subscribers. But apart from that, let's get started. Now, just a quick shout out, I did drop my UK portfolio review for September 2024. So that's where I go through my portfolio, all my holdings, how much to take up the portfolio, how much are up, how much are down, and also what I'm buying. And that exclusive video is on the Patreon. So if you do want to get some more exclusive content, 2 exclusive videos a week, join through the link in the description and you'll get access to the Patreon, the Discord, and if you're wanting to see more content from me, you can do that over the weekend while I'm not posting on YouTube. And you also support the YouTube channel. £5 a month for all that, guys. The price of a pint. It's the highest subscribers to Patreon on the whole stock market scene on YouTube, so go support the channel if you want to. But anyway, let's get on to number 1. So number 1 is my new UK stock, which I did a complete video on about 8 days ago, which was about 16 minutes long, which is Eurocell. So if you do want more of an in-depth video on this stock, it's there for you guys, and you can see my numbers on it and everything like that, so you can go check that one out. But I did buy some more Eurocell. I don't really buy too many new stocks in the portfolio. I normally buy a new stock in the portfolio, I'd say probably every 3 months in the portfolio, so it's quite rare when I do actually go buy one. But I did go buy Eurocell, 160 million market cap, so a bit more of a smaller UK company, 17 times earnings, but there's a bit of fluctuation going on in the profit at the moment, so probably not the best metric to be using. It does pay a dividend though, as you can see here, of 3.7%, so as you hold these shares, you are going to get a nice little bit of a dividend. Now, since I did buy the shares, the stock has been up a little bit, so do bear that in mind since I did actually start buying the stock. But Eurocell, they are a seller of building supplies, so they do things like facelifts, decking, windows, doors, roofing, external cladding. So you can see there's a lot of building materials they do through online sales and also having their physical stores out there in the UK. Now, the big thing obviously is that if you're selling these kind of building materials, you're kind of thinking, well, the big thing you need is a strong property market, which we haven't had in the last few years, which is what is impacting them at the moment. But if UK property does start rebounding and the mortgage rates or the interest rates still start dropping, that's going to see probably a big rebound in their sales as people do go buy more properties. And also we have the backlog where we have such a shortage of UK properties. At the moment there's 4.3 million houses missing from the UK, and we're currently building under what we need every year by about 50,000. And obviously, if Labour do what they say they're going to do, which I'm not sure, but we'll see, then obviously they're going to try and support also UK house builders, so we'll see if that happens. Now, Eurocell has recently got a new CEO. Well, I say new CEO, he's been there for over a year now. They did get Darren Waters from another big supplier of building materials, which was Timon. While he was there, the stock performed amazing on a chart point of view and a financial point of view, and actually recently it's actually just been bought out, and Timon was actually a lot bigger company than Eurocell. Like we said, Eurocell is actually a 160 million market cap, whereas Timon's like a $1 billion company, so it's like 10 times the size of Eurocell. And when this appointment was made, everyone was kind of surprised, like, you know, he's a really good CEO going to Eurocell, and what was the surprise is that a lot of people expected him to go on to another $1 billion company. The fact that he then went for Eurocell was, everyone was kind of like, this is a really good coup for Eurocell, and it looks like he's actually actually doing a really good job already in Eurocell, and that's actually the reason why I went to go buy it. One of the things that he's doing to improve the company is he's improving the capacity in every location. So at the moment they've got currently, I think, around 200 locations in the UK. I don't think I've got the number down here, but he's going to try and open up a couple of new branches every year. What he's also doing is improving the capacity. So he's brought like a new racking system in for like these windows and doors, where you can have more windows and doors for sale. If you've got more doors for sale, then obviously potentially if you're selling more volume, your margins improve and obviously your sales per location improve. And what they're saying at the moment is they've got current sales of around about 1,100 per week, and this is now because of their spare capacity from this new racking system of these windows and doors, they can actually sell up to 6,300 a week. So if you're selling more, obviously that means more profitability. You know, the scale of volume as well will also improve your profit margins, all while keeping the same number of staff and not increasing your location size. So that's one thing they've changed at the moment. So the big capacity that they can do in the windows and doors. They're also trying to do some improvements on what they are selling. So they've kind of been a bit slow to adapt to some of the new trends. So some of the new trends is like, for example, Conservatories were like the range like 10-20 years ago, but now they call them like warm rooms, and also offering more warm rooms. Single story extensions are more popular now, where people go, can't really afford to have a 2-story extension, but if I can build my kitchen out a little bit, I'll do that if it's a little bit cheaper. And also having like I don't know if you can see it here, but there's like windows on the top where the light comes in from the ceiling. Very popular as well. And this was actually quite slow to be launched in Eurocell. They were quite slow to adapt to that. And you can actually see that they only started doing that launch around about 2023. So even missed like the big boom from the last kind of couple of years in the housing space. So this hopefully helps them improve their sales as well. And they have a long-term target of getting to 500 million in sales, 50 million operating profit, which if we do look at what the company is valued at the moment, the company is currently valued at 160 million. So if they get anywhere to 500 million sales and 50 million operating profit, you can see here the company should do okay. Well, I say should do okay, it should do very well. And this is the bridge from where they are at the moment. So 365 million sales. They're going to try and get some new branches out here, the windows and doors, extend living, which we just showed with the new rooms, single story extensions, improve their digital site. They've launched a new website, which does look very good. Continuous improvement, just trying to find some parts that they can continue to improve, more efficiency. And that's how they get the bridge to 500 million. And they actually have just come out with their update this week, and that's one reason why the stock is actually up this week. And what was very impressive is that the revenue was actually down at the moment by 5%, but if you look at all the profit numbers held up. In fact, they actually did very well. And the reason why is because as well with the new CEO, he's been very efficient. He's cutting the business back at the moment, managing costs, and when the company goes back to growth, obviously that's going to then drag the profitability up, which is once again really good cost efficiency management from the management team that's there at the moment. They also did do a share buyback program. They extended the share buyback program by another 5 million, which is really good for shareholders. And if you do look at the company here, if they do go back to their growth that analysts are expecting and the profit that they're expecting, I think the business will do very well. It's a good balance sheet here. There's not much debt on the balance sheet, 5.8 million. They do have, my only concern is that they do have a very low amount of cash, but saying that when you've got such low debt and you are throwing off the profitability they are every year, I think they're okay with that. Ownership wise, there has been a few ownership buys, as you can see here. The CFO bought some shares, the chairman of the board bought some shares, so that's all really good that I want to see. So yeah, Eurocell is a stock that I'm buying. The next one is also in the construction space, which is Barratt Developments. So Barratt Developments has a lot of the same kind of features that we've just mentioned about Eurocell, is that housing market's been weak at the moment with all the inflation pressures. Interest rates have gone up a lot at the moment, so people are not wanting to get those mortgages that are £500, £400 more than where they were 2 or 3 years ago. But if interest rate cuts are coming, Barratt Developments should benefit from that, and the house sales should start recovering, and they should do very well. So Barratt Developments, as you can see, was a stock that has done very well, but since the interest rate started going up, you can see the stock has been affected. But there's a few people, as you see here, there's a rebound going on at the moment. They're starting to plan ahead. They're starting to think, oh, you know, if these interest rate cuts are coming, there's a few people starting to get in and buying the stock, and that's personally what I'm doing as well. Barratt Developments also came out with an update this week, and I gotta say the update was actually a little bit weaker from these guys compared to Eurocell that we just mentioned. They did deliver less houses than what was expected, and also next year they're also going to forecast some weaker growth or houses being delivered, which is obviously not good in the short term, but I'm looking at the long term. And in the long term, I think when you look at the housing shortage that we have in the UK, Barratt Developments will be there to fill that gap, or they are going to be needed to kind of fill the gap here. And obviously as well, they have bought Redrow. So I think this is a good move, because if they do get the cost savings that they are saying they're going to do, then this should also help the profitability in the longer term to rebound to where they were higher before these interest rates started going up. And we can start to see the recovery that analysts are expecting in the revenue and profitability. And if they start recovering to these sort of numbers that are expected, obviously the stock doesn't look too bad on a valuation point of view either. Balance sheet wise, obviously, pretty decent balance sheet, as you can see here from the company as well. Dividend wise, obviously the dividend is under pressure at the moment. It has been cut slightly since, well, I say cut slightly, it's been cut more than slightly. It's been cut because obviously the profitability is lower. That makes sense. But if we do see the recovery in the housing sector, Barratt Developments comes back, I think you'll also be collecting, obviously a higher dividend as well here. Insider wise, there has been, I think, some insider buying, but it's just kind of gone off here. So there was some. Barratt Developments, why as well, a few people might say, like, why out of all the house builders, why Barratt Developments? And my case has always been like, I don't really like new builds. I don't really like them because obviously you got the problems, and I think a lot of them don't look very good. However, Barratt Developments is the one that I actually think if I was to buy a new build, I would buy probably Barratt Developments one, because I think they have a lot more personality around the houses. In fact, before me and my missus bought our current house, the one new build that we did consider was actually Barratt Developments house. We never did buy it though, but it was the one that we did consider. And out of them all, like, they seem to have the least problems out of a lot of the house builders. You go on Trustpilot, it's got 4.4 stars out of 5, which is pretty good for a house builder, because with the amount of issues that can go wrong with a new build, it's actually not too bad at all. So that's why I do prefer Barratt Developments. Next one is Money Supermarket. So I've been buying this one for a while. It's a stock that I started buying this one around about the start of 2023, I would say. It was around about the £1 range, and then all of a sudden the stock actually started rolling up, and I was like averaging up a little bit. And I thought, okay, I'm going to have to build out a position a little bit higher. And then within like the last kind of like this year, really, the stock has actually fallen a fair amount. And it's a bit frustrating because I was buying a lot, and then it now gone back to where I was at. And I was like, I could have waited and bought it a little bit cheaper. But I don't mind, because actually at these sort of levels, I quite like Money Supermarket at these levels, where I'm considering making it a top 3 holding, maybe even a top holding in the UK portfolio, because I'm getting this company for 14 times earnings. Historically, this company actually normally trades around like 20 times earnings, so it's at quite a big discount to what it normally trades at. Dividend yield as well, I don't have to really do anything, and I get a 6% return, which is really nice. Obviously, when interest rates get cut as well, I feel like a few people might be jumping into that stock, because you've gone from getting that easy 5%, and let's say it goes down to like 2%, 3%. People will be like looking for dividend stocks that maybe they can get higher returns on from a dividend point of view, and maybe that's one of them. But I also think there's a lot of key drivers for them coming up. Obviously, a comparison site, so you can see here that it car insurance, home insurance, broadband, mortgage deals at the moment. And what normally happens with this company is there's normally a weak part of the business, but because they have so much coverage, other parts of the business make up for it. So, for example, at the moment, the one big thing they used to have is the energy switching market, which I actually don't think they've even got on the homepage now, because there's not really much energy switching going on. And that was a big part of the business, and that's something that can still come back at some point. Travel has been strong at the moment as well, but what we'll have is, if interest rates get cut, we start having the rebound in the likes of mortgage deals. People be on here for mortgage deals, for example. So there's a lot of key drivers that are potentially coming up for Money Supermarket. But the big thing is the energy market. They've not had the price comparison for the energy market for like the last kind of 2 years now. And when the energy market comparison starts coming back, that's going to be a really big driver for them. And it might be Easter next year. It could be earlier than that. Which, by the way, also Money Supermarket do own the Money Saving Expert website that I'm on right now, that Mine Lewis posts on. And if the energy market does come back, that's going to be another key driver for them, because basically, you know, that platform is sat there waiting and not doing anything, and as soon as that comes on, that's going to be straight revenue and profit, you know, for the business. And you look at the company here, it's still doing really good numbers. You know, the growth of revenue was still 5%. The EPS grew 9%, as you can see here. And when you look at the numbers further down for each of the category, you know, a lot of that was kind of coming from the insurance, with the insurance premiums going up at the moment because of inflation. But you've still got all these parts of businesses, for example, like home services. You know, as soon as that energy market comes back, you know, imagine how much that's going to start rebounding by. So there's all these key growth drivers that potentially could happen for them. And as that does start kicking on, we're going to start seeing the revenue go up, the profitability goes up, and if we start seeing them go, I mean, without even the energy switching market at the moment, the company is already higher on a revenue point of view than where it was before the whole COVID situation. That energy driver comes back, you know, this is how the company used to have 23-24% profit margins. You imagine that goes back up to like 23-24% profit margins on the current revenue basis that they have. Yeah, it's easy for this company to go back up to like 100+ million in profitability. You know, you put 100 million in profitability on a 1.1 billion market cap company, you know, imagine how cheap that's going to look, and the potential for dividends as well is going to be very good. Financial health wise, pretty decent balance sheet as well, you know, only 21% debt to equity. They've got a decent cash pile, obviously throwing a lot of profitability off each year as well, you know, nearly 100 million profitability, or should be nearly 100 million profitability. A lot of potential for acquisitions there as well. Consistent dividend growth, as you can see here. Ownership wise, there has been some insider buying. One of the members of the board did buy 20k worth of shares and then bought £19,999 worth of shares. So yeah, I like this one a lot. I'm really thinking of making it a bit of a even larger position. Next one, Watches of Switzerland Group. So yeah, I bought in the start of August, Watches of Switzerland Group. Obviously, if you've seen my video this week, I did take a little bit of profit off the table, but that will be featured in next month's video. So just bear that in mind when you're looking at this. But it did have a dip at the start of August when we kind of had that flash crash that was going on, as you can see here. I thought I'd buy some shares. I did buy some during that time frame, and I still own a lot of shares in the company, and I think it is a stock that should hopefully do quite well in the long term. So Watches of Switzerland, they do sell luxury watches with the likes of Rolex, for example. Obviously Rolex is not a public company. They don't sell direct to the consumer. The only way you can really buy Rolex is from someone like a approved supplier like Watches of Switzerland, and it's really your best way of actually owning Rolex, which I think is obviously a quality business. But Watches of Switzerland obviously is a retailer of luxury watches, but the problem is with the stock, and if you look at the stock, it's been having a tough time at the moment. That's why on the share price it was COVID times and then a big boom, and then it fell down, and the stock is actually now lower than where it was before the whole COVID situation. The big fall off on the stock price is basically when you look at the luxury watch market, it has absolutely crashed. We had a big surge in prices. People went out during COVID and bought loads of luxury watches, and they were buying it because they had so much free cash. Interest rates were very low, and you had the kind of that demand pull forward, and you had people that were buying luxury watches that probably should not have been buying luxury watches. And then we've kind of had the correction in the watch prices, and that's kind of seemed to stabilize a little bit more. And I feel like what we'll see is that as the economy hopefully starts having these interest rate cuts, is we see the stabilization and then the recovery in watches, in luxury watches and Rolexes, because historically that's what happens. You know, historically it's a market that does continue to carry on growing going forward, and I think it's just having a correction. What they also have launched is their pre-owned Rolex certificated watches. So this is where they sell second-hand watches, which has done very well for them recently. This was a recent launch, and obviously hopefully gives them more in this time frame when people are a bit more reluctant to spend maybe on the brand new watch, to go get a second-hand one, and also hopefully gives them better margins. You know, selling second-hand watches where you don't have to pay big fees up to Rolex is obviously hopefully something that makes them more profitability in the long term. But the reason why I bought it is because they're expanding into the US. So in 2021 they announced that they're going to expand into the US, and that's what they've been doing. They've been opening a lot of locations in the US, like for example Wynn. They've opened up a location in Wynn. I'm sure you know Wynn Hotels. They've opened up a location there, which is obviously an even bigger market than the UK, you know, more locations, and also there's a lot of more luxury locations like Wynn where people from international are willing to spend the big money, and that's where the growth is currently going from. Even in this time frame that's a little bit weak, the US sales are still growing 14%. The company's been held back a little bit more because of its EU and UK at the situation at the moment, but that's where they're expanding to, and the growth even in this time frame has been absolutely amazing. Now, the last trading update, and the reason why I did actually go on to sell some of watches Switzerland, is that they did do a trading update and they said they are in line with expectations, but they gave no numbers. Worth pointing out that someone actually got back to me on Twitter or X, which was investing. He said, to be fair, they did say that they are not going to give as much detail on the updates going forward in the last one, and I actually made a video on this and I actually forgot about this point. So it's a good point that one of the reasons why I was a little bit cautious they didn't give some financial numbers, but this is actually a good point that maybe it's because of the new reporting system. I still think they should have probably given some form of numbers here, but it was a good point that was made. So good counter argument there, invested, that posted that one on X as well. So something to kind of think about there. But yeah, the big reason I'm buying it is the long-term game plan. You know, the long-term game plan is to double the revenue and profit by financial year 28 through that US part of the platform, which is still doing quite well. And if they get anywhere near there, I think the stock will obviously, or the share price will obviously do really well. And you can see here that if you look at the past performance, you can see the big explosion during the COVID times where the revenue went up a lot, the profit went up a lot, which, by the way, the stock has now gone back to the same price before COVID, but you can see here the financials are nowhere near where they were at before the COVID times. Financial health wise, a pretty decent balance sheet, as you can see here as well. However, saying that, I think when the acquisition numbers do update on Simple Wall Street, that debt balance will jump up a little bit at the moment. But with the company saying that, you know, the company hopefully goes back to, you know, let's say 100 million profitability, which on a 910 million market cap makes it look a not too bad valuation, and they're going to have that option to use that cash to potentially go and pay down some of that debt. So within like the next kind of couple of years, they should really sort out that balance sheet, which should be okay. And insider wise, we did have some insider buying with the chairman of the board and the CFO buying some shares. They bought that around about the £3.90 range, and actually when you do look at the stock at the moment, if I can find the stock price, yeah, it's actually lower than where they bought. So good to see some insider buying, and actually for yourself you can actually pick these shares up a little bit cheaper than where the insiders bought them. And that leads me on to the last stock that I did buy, which was Warpaint. I did buy some Warpaint shares, and I gotta say, as I was putting this video together, I actually looked at it and I went, I think I probably should be buying more of this stock because it's actually looking very impressive. So Warpaint has been a very good performer on the UK market. Today it's up 47% year to date. In the last 5 years, the stock has nearly been a 10 bagger. So yeah, very impressive. It's still a 434 million market cap company, so it's not a major size. It's a decent size for a UK, but it's not major when you compare it to the likes of Elf, for example. 31 times earnings, but because the profitability is ramping up that much, it's actually a little bit cheaper than 31 times earnings. They do pay a little bit of a dividend as well, which is actually quite nice. And Warpaint, so it's worth actually pointing out as well, they are going to be doing a interim results on Tuesday the 17th of September, so there'll be some updated numbers sometime soon if you are watching this a little bit later on. But what they do is they do most of the revenue comes from this W7 brand. And obviously they sell a lot of like makeup brands. They have what they try and do is they do some dupes. So dupes is where they have like these luxury brands that are like £40 for a makeup set, and Warpaint, you know, maybe do like a similar version that's half the price of what that is, but also it's known for doing the cheaper products and also being quality. So they try and get you in with these dupes, and you go, oh, I use that Warpaint as a dupe, and actually it was really good quality. I'm actually also going to use some of their other products that they do at the moment, and they've done this through the UK, through retailers, and they're also expanding into the US. Now, like I said earlier, the valuation looked a little bit rich at 30 times earnings. If you look on a forward basis, it's actually down at 16, which doesn't seem too bad. And the 2023 numbers were absolutely fabulous. So you can see the UK market where they're more mature, that was up 18%, but the growth is in Europe, the US up 37%, and also their direct-to-consumer online sales was up 121%. Some more partnerships, obviously a lot more in the US that they're expanding to at the moment, and you can see the growth since the pre-IPO, and you can see really why the stock has done so well, because over the years that growth has been absolutely amazing. Now obviously they've done really well in the UK market, which is a 1.8 billion market. They're going after that US market, which is an 18 billion market, so 10 times the size of the UK. So if they can do what they've done in the UK and the US, that would be absolutely amazing. In the Q1 update, the numbers look very good. Revenue was up 28% here, more partnerships as you can see here, and yeah, good outlook guidance given. And what that led to is, if you look at the growth of the company, I mean, look at the growth and the profit that's been driven up with the company here, and it looks very good from that point of view. Balance sheet, as you probably would expect for a company like this that throws off this amount of profitability, the balance sheet is pretty good. We've got no debt on the balance sheet, as you see here, and cash wise, healthy amount of cash pile that they can potentially throw off into dividends or share buybacks, as you can see here. There has been some concerns that the CEO and founder did sell off a chunk of shares that you can see here, quite a big chunk as well, you know, nearly 15 million worth of shares. Worth pointing out though that the CEO is obviously and the founder is up 10x on them, so is there anything wrong with taking a little bit of profit off the table? And he still does own, both founders actually do own 20% of the business, so it's not like this, you know, even though they reduced the stake by 18%, they still own 20% of the business. So I definitely think the best interest is still to see that share price go even higher, but I think for what they were up on the positions like 10x, I think there's probably nothing wrong with taking a little bit of profit off the table. So yeah, I looked at the company and I just thought, you know, 16 times forward earnings for this business, and if they grow at like even 10% a year, it looks like a good business. But realistically, it's probably going to grow even higher, you know, teen range going forward, and I think that definitely looks like a good value. Where I actually thought when I was making this video, I was like, why am I not buying more? So yeah, we'll see what happens anyway. And that leads me on to the one stock that I did sell. So I did sell a trim. It wasn't my full position that I did sell in the stock. I just trimmed the position slightly. And once again, I did trim my position in Supreme. What a year this has had. The stock was up massive. It was up like 90% when I did start taking the trim here, and I took I think it was about 5% of the position that I trimmed, and it was for a 90% profit. I just trimmed it because I thought, you know, it's gone up so much. Any sort of risk around, you never know with the new government, if they put anything out with vaping, it will spook the stock. And from that time frame, actually the stock has fallen slightly, and it's fallen like nearly 20%, and I'm actually thinking about maybe buying back in now and take that profit that I did take off the table and put it back into the company. It is worth pointing out that the Supreme also have a AGM as well coming up on Thursday the 19th of September. They might do a trading update then. But yeah, I really just took it off because at the end of the day, you know, we're all here to make money. I made a lot of money on Supreme, and I thought, you know, just the 5% off the table, because Supreme can be volatile with the vaping products that it does sell. Any sort of regulation news will spook the stock, and I thought, you know, it's a good time to take that money and maybe invest it in some other opportunities, because as you've seen, there was opportunities out there, and that's what I did. However, I'm looking at it now, 20% drop, you know, back down at 9 times earnings. Do I maybe put it back in? It's something that I'm thinking about. But yeah, that was just locking in some profit, because at the end of the day, there's no point doing all this investing game if I never take any profit off the table to go buy new things or go treat myself with something, I don't know. So yeah, that's what I did with Supreme. So yeah, still own, you know, I still hope the stock does, you know, very well, because I still own a good chunk of shares. But I think just to sell off a 5% of that position for a 9% return was very good. And if any of you guys are Supreme shareholders, I'm sure you're also very happy as well. That's the video for today, guys. Wow, that was a bit of a long one. We nearly pushed the half-an-hour mark on that one. I hope you enjoyed the video. If you could, hit the like button. If you're new around here, subscribe and help the channel out. I will not be doing a video on Saturday. I'll think about maybe doing one on Sunday. It depends how much time I have. If not, I'll see you on Monday. Unless you're on the Patreon, obviously you got the exclusive content to watch over the weekend, and also I'll probably talk to you on the Discord as well that you do get with the Patreon. Apart from that, thanks for watching, guys. Catch you in a bit.